traditionally that would mean like bank statements and pay slips, and that's unbelievably painstaking. And I think that we try and speed that section up as well. And the journeys I'm going to go through today are our manual assessment platform called Atlas.
Hey, welcome to Homescreen. I'm Jim Safford, and today I'm going to be joined by Kitty Sadler from Credit Kudos. Credit Kudos is a product that's made a huge impact on both open banking and the credit rating of credit bureau spaces. Today we're going to talk about a few things, get quite a lot of content out there. There's going to be a flow there to show us how the user will connect their account to Credit Kudos, see how a lender can assess an income verification, so how a lender can reasonably underwrite based on banking data. The affordability side of things, so how the platform anticipates the spending ability of the user in the future, and then a risk side of things, so how the product can keep up to date with the user's risk profile and suggest better habits for them. Could you start by telling us a little bit about you and how you ended up getting involved with Credit Kudos?
Yeah, so I mean, a bit roundabout. My background is actually in political philosophy and social science, and I started working originally in an education charity.
Cool.
I moved into tech. Yeah, I moved into tech from there because I was kind of got really excited about building stuff that solved really real world problems, and I kind of saw how quickly that could happen in tech, and when you could join somewhere and be involved straight away.
Yeah.
I initially worked in e-commerce in a few different roles, and that gave me some really good experience. But I always felt kind of longing to bring that back to kind of my social science background and be trying to solve a problem that isn't just kind of making more money. And that's not always the case in e-commerce, but I wanted that connection with kind of real human problems and human data. Sure. And I was kind of lucky enough to find Credit Kudos, and that kind of combined those two things for me.
Yeah, and how long have you been involved with Credit Kudos then?
I've been here it'll be 2 years in October. And
you guys have been pretty. There was a pretty big raise, I believe, a few weeks and months ago now. Just right at the beginning of the lockdown, I remember there's a lot of noise around what was going on with Credit Kudos, and of course you were involved in a product which was sort of, I guess, being worked on by the fronted guys and by 11FS, Simon from our company as well. So getting involved with what's going on out there in the community, that's really interesting. Could you tell us a little bit about what Credit Kudos actually does and what the kind of the marquee features are of the product as it currently stands?
So we are a challenger credit bureau, and we help lenders and other companies to provide people with fair and affordable credit.
Yep.
To achieve this, we harness financial behaviour data, and that consumers share with consent through open banking, which I'm sure you're familiar with. And as a bureau, we can combine this data with loan outcome data, and we use machine learning and kind of other analysis, other techniques to predict credit risk and affordability more accurately than you can with traditional credit bureau. We do that across kind of a range of we call them solutions, but these are kind of our key features. We support income verification, we support affordability. We do kind of risk insights, that's our real kind of bread and butter, and we also do customer management. And the kind of result of all of these different parts of a credit decision is a kind of faster and more accurate credit decision for lenders. Basically, it helps them to reduce defaults and lend to more people who can afford it. And obviously, in current circumstances, this is more important than ever. People have been financially really hit by COVID and everything that's happened. More people need to borrow. And also what's really kind of, interesting is the current situation is so unprecedented that traditional credit scores just aren't as predictive, and open banking is really important for that.
And I guess there's a speed component there as well, in the sense of one of the big marquee things that I remember Simon talking about with this COVID credit problem that they were working on with you guys and with Fronted was that this is a an issue of providing lending decisions to people very, very quickly. My understanding of the solution was that you have, for something like the C-bill scheme, you'd have like you'd need to pair someone up with the correct loan deal in the first place, which is in itself, I understand, quite a tricky process. Then go through KYB and KYC processes, and then finally actually ship that money. 3 quite complicated and lengthy steps.
Absolutely.
I remember Simon from Fronted saying on Twitter, quite officiously saying, I could build something like this on a week on top of Credit Kudos, which is outrageous. So there must be a huge speed component. Is that a derivative of kind of being involved with the open banking API network? How does that work from your perspective?
Yeah, I guess so. I mean, I think the traditional system always had a automated real-time component, but the problem with that is that it just was very one size fits all, and if you fall out of that process, then you kind of can't get back in. Whereas open banking gives you much richer, more accurate data for everyone, and you have there aren't pockets of people who are underserved or excluded from the kind of current bureau system, and you can introduce a lot more nuance. I think also, the traditional bureaus, the data they provide just doesn't give you such flexibility to build really nuanced processes that maximize how much can be automated. Mm-hmm. And I think the clients the lenders that we work with, we basically work with them to automate and make real-time decisions for as many people as possible. And then there's always going to be a segment of people who have to be manually underwritten, that it's about getting that as small as possible, but there's always going to be a segment. And for them, we kind of traditionally that would mean like bank statements and pay slips, and that's unbelievably painstaking. And I think that we try and speed that section up as well. And the journeys I'm going to go through today are our manual assessment platform called Atlas.
That it's not just about connecting via open banking, which speeds up the process, but it's also the processes, the administration that goes alongside open banking that allows a quicker sort of decision in this regard. Absolutely,
it's everything. So a user journey traditionally might be that you have to submit bank statements or pay slips. And often that's not even embedded in the journey, so there's not even an upload link. So you're given an email, and this is really how it goes. You're given an email and you have to go away and you scan your statements, and then the underwriter comes back and or the customer support person comes back and says, oh, actually that one's really blurry, you need to retake it, or your thumbs over the transaction, or all these kind of things. So it's quicker for the user. And then once they go through that open banking journey, which can takes just a few seconds, we kind of slice up all the data and we do all of our analysis in a matter of seconds. And that means that you can do your calculations as a lender on top of that and present a real-time decision in just a few seconds. So it speeds up every part.
So we know there's a difference between you and the credit bureaus, but someone like TrueLayer or OpenWorks or these API providers, is there any similarities in the way that you two operate?
Our key difference is that we're both a bureau and an open banking provider, and that means we're uniquely positioned to combine open banking data with loan outcome data. And it's those two sides of data, your kind of input and your output, which means that you can analyze, model and predict risk, and basically understand what's happening in the open banking data, and that will make somebody good or bad for credit, or risky or not risky. We're just interested in risk and affordability and a couple of similar things like tenant vetting and a few similar areas, but all of our insights and all of our energy is on understanding that relationship between financial behavior and risk and affordability.
You are, this is of course a product, and you are a product manager, so I guess there is a component of process involved with how you're shipping products out there in the market. Is that something that you think about in a sort of systematic way? Do you rely on any particular processes to do?
Yeah, hugely. I mean, we're a tech company first, and we're really kind of excited about that, and we practice kind of a lot of the latest thinking in the sector. We together as a team, we built that from nothing, and it's really important to us. We're talking about it all the time, and we've seen how much of a difference it makes when you have a really good product system and a really good product culture. I'm not sure if you're familiar with OKRs, objectives and key results. I'm sure you are, but we're really big fans of that. We think that it helps you to focus on kind of outcome over activity, and helps you to kind of everyone in the business to align and be working in the same direction. And it takes so much mental energy out of your day of thinking about what's good and what you should be doing, that you can then focus on kind of solving the actual problems. And we kind of assemble cross-functional squads around particular levers that go into those objectives. So we have a squad just for end user conversion of our Connect journey, which I think we'll see in a minute. We have squads for our underwriting platform and reducing time to decision, and all those different levers. We have a squad that has freedom to kind of test and learn and build continuously against those objectives, based on impact rather than output. And we believe really strongly that it's important to give engineers and designers and research people just freedom to do what they do best, which is solve problems really creatively, and you should just give them the structure. So yeah, that's really important to us.
I think there's it's pretty similar here. I've just started thinking about a methodology being used by Basecamp at the minute, which is around, I think, 6 weeks batches of work.
Yeah.
Did you hear about this one? I think there's a book written.
Or Shape Up or something.
Yeah, that's right. That's a really interesting notion there. Like the purpose of, I never thought about it this way, but the purpose of the product manager's role there being to define the context and the scope, and then essentially to give handoff sort of bits of work and say, this is the parameters within which you operate. Go and do a thing. Gives them the creativity and the scope to do the thing they need to do, and then also make sure that it's small, reduced bets rather than large.
Absolutely. Yeah. And I think we're learning more and more that, you need to build as much structure around that discovery phase as you do around the build phase. And I'm kind of familiar with Shape Up. They do these discovery and then build cycles, and they kind of always have discovery going on during build. I think that's something that we're definitely kind of been thinking about, and thinking about how we can fit that into our process. Yeah. We also use jobs to be done, which we're like really big fans of, because it helps you to build that context and helps you to just focus on the need and why you're uncovering that need, rather than getting caught up in how something gets built. And as soon as you start prescribing that, you miss potentially really interesting solutions. And I think also, you mentioned the kind of the COVID credit work that we did. I think you need the structure of always reviewing what problems you're solving and reviewing the needs, rather than just focusing on a roadmap. Otherwise you're not agile enough to kind of pivot to a new thing when new information comes in. So it's really important.
Sure, for sure. And then with that jobs to be done work there, I think there can be a tendency often for organizations. I know I've been guilty of this in the past with our own products, of doing the work once and then sort of like letting it get stale, and not like refreshing or figuring out what new, because things like that can change. Do you have like a process of how, is it reviewed a certain number of times, or do you think?
Yeah, I think we're trying to, I think we're grappling with that. And I think when you're growing initially, when you're a bit younger, you're just like onto the next thing as quickly as possible. And but I think actually, rather than trying to build a specific process around it, what works for us is to be just really focused on the lever. And as long as the lever is good, as long as you know that, if I move this metric, then I'm doing the right thing, that should dictate everything. That should basically tell you, like, is it more effective to build this new thing, or return to something and review it and improve it? Mm-hmm. Because that OKR framework forces you to validate any assumptions you have about what's going to move that lever. So, constantly we're saying, okay, well, there's these 4 things we could do, which is going to move which is going to move the lever most, and you have to basically just set up experiments or seek to validate. And I think that hopefully will take care of that side.
Great. I'm going to share my screen now. We'll look at the first journey that you mentioned.
This is our Connect Flow product. It's like an embedded button. That Connect with Credit Kudos button is a little plugin that you can basically drop into your application flow. Yep. And then it opens up a Credit Kudos window, we present all of the authentication. We securely connect to banks' APIs, and we aggregate all the accounts you connect. So you can connect multiple accounts, and we'll aggregate all of those into one kind of single financial view. And then we send the user back to the application, and that's where you could do a real-time decision, or you could say, great, thanks, we've got your information, we'll be in touch. The banks took on an enormous task to get these APIs working and ready, and we were working really closely with them on finding issues and reporting downtime, and it was like a big effort from both sides. I think also, even when you write really amazing API standards, until you see real data coming through it and that data is used, you don't really see what needs to change. And there's been a few different there's been a few different versions of the open banking APIs to work out. I think it was more challenging in the beginning. There's been a huge improvement recently, and I think that has really supported much better conversion, much better engagement, much better volume. I think the one interesting dimension is that despite the API standards, each bank within that, still being compliant, but will have their kind of own interpretation of their own translation from their way of understanding balances and credit limits, just for example, to translating that to the open banking standards. And there's a lot of work across all of those banks to understand that the data is correct and make sure it's correct and translate it into kind of our common representation. But it's been much easier recently, and we obviously only onboard banks when we're really happy that they're secure and that the data is accurate, and we've been able to do that more and more recently as open banking has matured, which is great.
Okay, great. And this is, I would imagine, the account initiation services part of the banking APIs you're using here. You're not particularly interested in payment initiation services or, variable rate direct debits or anything like that down the line. Are you looking to play mainly in this space? I'm
probably the right person to say too much. We're actively exploring it, and we're definitely interested to see how it will unfold, and it's something that we are actively researching and thinking about it. But in terms of what we do right now, we do AIS, yeah.
You mentioned there that this is like a little widget, button that you plug into the product. Sure. What's the sort of typical person who would use not just this sort of plugin, but kind of the users of those products themselves? Who are the end users for you guys?
So we work with a huge range of lenders and a few different sectors that are similar to lending in terms of the flow, but aren't quite. So within lending, we work with mortgages, personal finance, motor finance, the whole spectrum really. Lots of credit unions, community lenders, and then kind of outside, and credit cards. And then outside of that, we work with some tenant vetting and some kind of subscription services as well that need to do similar kinds of checks. So a huge different range of consumers across the kind of a big range of different lending products and use cases. Yeah.
What kind of information were you looking to include on that sort of flow? How did you decide how essential each bit of information was for something like AIS? Obviously, as I said at the beginning, this is a pretty standard sort of process that you can see in terms of connecting. Was there anything in particular you wanted to include to make the experience better? Obviously, when you move into other people's interfaces, it can get a bit tricky.
Yeah, sure. So there's two sides. There's our Connect Flow product and the UX and the content of that. And then there's everything before that button, which is not controlled by us, but is really important for us to get that, to prime people, not just to engage with that button, but also to be well primed to continue all the way through. And obviously because of our, who we are and our kind of mission, it was really important for us that it was, we really put kind of consent and at the heart of what we do, and make sure that it's really informed consent. So there's the open banking guidelines, which are really good and really well researched, and they provide a framework of what they recommend and kind of strongly recommend. So obviously we have to work within that. Within that, there's quite a lot of freedom, and so we have a whole squad that is focused all the time on conversion, and they've done a lot of they do kind of ongoing quantitative research. So use some really interesting tools to kind of measure conversion at every stage and run all sorts of experiments and improve conversion all the time. And then we've also done a lot of qualitative research with end users who are in the market for loans, and really trying to make sure that we give them the right amount of language that means that they're guided through that process, that they know exactly what's going on. And it's same with any kind of, this UX content challenge, where you want to provide enough information and not too much.
You did mention at the top of this interview that there were 3 states that we're going to look at in from a video perspective. So we're just going to jump into the first. Great. So we're on a reports page, and we've got summarized a series of different categories. What are the key things that we're splitting out here from that summary figures side of things?
Yeah, so in a kind of income verification context, lenders frequently will need to verify income manually. If they're using a traditional automated credit check, they'll be referred. So they'll be going in, and they will want to basically create a realistic prediction for income over the next kind of few months. So that's what they'll be focusing on in the summary figures.
And we've got balance over time, which we're focusing on a little bit here.
Often people will get multiple sources paid into the same account, but they might have other accounts with things going on, and we aggregate it all together. We do all of our classification, grouping, predictions, all of that, these kind of layers of analysis we do on the report as a whole. And we also understand the relationship between those 2 accounts and the flows that go in and out. And then we create this kind of single view of income, which is obviously much, the aim is that it's much quicker to review than going line by line through bank statements. And also when you go line by line through bank statements, you're so in the weeds that it's very hard to spot patterns. So we kind of bring the sources together. We break down the predictions for each sources as well as the overall predicted income amount. And then we score the income based on different dimensions that underwriters are usually looking for when they're digging into transactions. And then the scores will kind of tell you whether you need to go further into the transactions, and they're all in one place if you need to.
When you're talking there about what lenders will typically be looking for, what sort of things are they looking for? Is it what we've just seen there around the regularity and other such like?
Absolutely, yeah. So usually, if you have a predicted number, which is what we think your salary is next month and the month after, kind of contained in that is, how much that varies by amount, and that's might be a couple of different dimensions. That might be, that it varies regularly, but not by very much, or it might be that it varies a huge amount. And it's important for underwriters to know that, so they can decide if they modify their predictions. They also will want to know how long that's been going on for, because the longer it's gone on, the more confidence they have that they can use that number. They're also interested in the regularity, because if you're paid a certain amount, but it just doesn't always come in, you might not be paid at certain times, then they need to know that and potentially modify their prediction so that they're not giving you an affordable loan, basically. So they're giving you kind of a loan that you will consistently be able to afford.
Sure. Yeah. And so I guess we sort of answered my next question, but this is a view for the lender themselves. Then we've seen in the first instance a view for maybe the borrower or someone else. That.
Yeah. So in a kind of
lender specific view.
Yes. Yeah. So these we offer kind of the automated side through our reports API, so you can build that into a real-time process. And then for the portion of people that you need to manually review, and that's by an underwriter. So lenders will have a team of underwriters who are kind of experts, and they will use this platform as opposed to working through bank statements, using spreadsheets, using pieces of paper.
Yeah. Okay. And you scored income there as well in this process. So how does that generally work?
Yeah, so the idea of the goal of the scores was to kind of compress many different dimensions of review, as you would review as a human, as an expert underwriter, into kind of single dimension scales that mean that you can compare different applicants, or you can start to develop thresholds for certain things. And once you do that, that really moves you towards automating certain aspects of the decision, because you might say, okay, I need a regularity score of over 60 to progress this person. Or you might say, if their regularity score is less than 60, then I'm going to modify their prediction by X%, just as kind of an example. So what we did was we spoke to a lot of lenders and, poured through a lot of user research and interviews about how people verify income and what they're looking for and how they might interpret or modify a prediction and arrive at a number. And then we took all of our big corpus of data, which is hundreds of thousands of reports, and segmented them to understand, what these different ways that income might vary, basically, and that we kind of arrived at these 3 dimensions, which are amount, consistency, regularity, and longevity.
It's a really interesting view, and I guess from what the main thing that you're trying to do there is verify income. That's the top level sort of goal, and presumably that's that view becomes available after the user's connected their account via that sort of earlier flow that we've shown. How quickly can one expect to get that sort of a screen as well, sort of fed as that one?
Between 5 and 10 seconds.
Oh, that's great.
Yeah.
And how do you, I guess you use this on a lot of the pitch decks and that sort of thing that go into using Credit Kudos, but how long would that usually take, just for context?
How long would the income verification journey take? So we measure, we do a lot of kind of measurement in Atlas of how long people are taking, and we're always trying to get that time down, so that we can help people make decisions quicker and we can help lenders kind of streamline. It's across the board, it's a couple of minutes on average to fully review an applicant. On the income side, it's much shorter, and you kind of can see in that video that we use kind of throughout Atlas, we use this idea of progressive disclosure, which is that some people are going to be you're immediately going to be able to verify that they have the exact income that they stated on their application, and you don't need to dig deeper. And then the next layer is that you might look at the sources and you look at the scores, and you're satisfied that the scores are all green, and therefore you don't need to dig in. And then we want you to, the transactions, individual transactions are there if you need them, and they're all in one place, but they're you only need to dig, they're only there if you need to dig deeper, basically.
And so for the average competitor of yours, maybe the older school sort of credit decisioning agents, how long would that process for them take compared to this?
I mean, there kind of isn't really a process between the automated checks. So the bureaus use this kind of current account turnover data to estimate your income, but obviously lots of other stuff is going in and out of your account. It's quite hard for them to predict income, and they also don't give you the number. They'll give you a kind of a yes or a no against an amount that you submit. So if that doesn't work, it's a really long process. It's bank statements, it's a back and forth. You have to request the statements. You have to kind of go through them. It's really easy to miss things. Sometimes they do pay slips, but often it's bank statements, and that's a really time consuming process.
Yeah, I guess we can't really compare the two then. The next journey we're going to look at is related to affordability. We've got this summary figures area again, and then in the dashboard view we have a liquidity view alongside income stability. These fixed expenditure area, which has got loans, current current monthly amounts out on loan, or is that we've currently lent, or what's
so these are the this view is basically everything that the applicant is spending, or that we predict that they're going to spend. It's a view where you can easily see how that rolls up into kind of fixed expenditure. And affordability is basically it's what lenders have, what an applicant has left over after their income, when you take their income and you subtract their essential spending. And affordability is basically, is the loan affordable for this customer? It's a requirement of the FCA to basically establish and prove and explain affordability. So we again, with we come up with these we have these predicted numbers, which are these high level numbers, and we also let you dig into those. So these are the predicted amounts for each category that we would count in essential spending. And then within each category, we highlight the what we call recurring payments, which are kind of part of the picture, but not the whole picture.
So, and then on the left-hand side there, we've got these sort of larger, more general sort of categories.
So we have a kind of a set category taxonomy.
Okay.
What we would count in essential spending or fixed expenditure, and then what we would exclude from that, and our categorization engine, along with our kind of prediction algorithms and outlier detection, kind of sets that. And then in that view, we only highlight what we see. So if we don't see anything for housing, you won't see it in that side of the panel. So you do get a range of some people obviously have a full set of housing expenses. Some people are living with, in a place where they just pay rent, for example.
For sure. And not to spill any beans, but I guess you might have seen some quite interesting things in there before. Lots of different expenditure you might not have expected. How do you account for things that might fall outside of the taxonomy and maybe they're not covered by your predicted analysis of
I mean, this is one of the most important things we do is classifying expenditure in a way that you can confidently predict essential expenditure, predict what people have left over. So the aim of the categories is to have full coverage.
Yeah.
And if we don't know exactly what something is, we can also fall back and say that we do know it is essential expenditure, or we do know that it is non-essential, and it's really important that we get that coverage. And we have over time added more categories if we find that there's things that kind of don't fall into the original taxonomy. But we work really hard to understand every part of somebody's spending, because it's really important. If you have a large expenditure that you're spending every month and we haven't classified that, and that's £300 a month, it's essential that we account for that somewhere, and we make that really clear, because could be the difference between somebody being affordable for a loan and not affordable. So we take that very seriously.
Sure. Well, very politically avoided the earlier question there as well.
Of interesting spending. Well, I mean, I think something that has been shocking for me personally is, I think it just doubles down on our mission, is that, there are people who, are working full time and are still in credit spirals and don't have access to, people who are working a really good job and, and full time and are doing everything right. And they don't have access to, affordable credit, and it really, really affects them. So that's very important.
You have a definition of affordability there, how would a traditional lender describe that, and what would you describe that as an organisation?
Yeah, so the FCA, the Financial Conduct Authority, say that basically they just say that you need to accurately estimate income and essential spending, and the loan can't be bigger than the difference between those, basically. And they define essential spending as spending that can't be easily reduced. Mm. And so you potentially to reach a financial commitment, you could tighten your belt on the luxuries, but you can't be required to sacrifice like basics, like basic important expenditure for life. And that's kind of remained the same, but the FCA have got kind of increasingly and it's good, required people to prove more and more that they're sure about this person being affordable. And traditionally, a lot of lenders and bureaus used ONS benchmarks. So you basically say, this is the average spending for this person of this income bracket in this area. And the problem with that is that you're going to be excluding some people who are affordable and spend less than the average, and you'll be lending to some people who spend more than the average and aren't affordable. So it's just a real compromise of accuracy. We try and do as much of that legwork as possible, and much of that research and all the classification and the prediction work to reduce the kind of burden on them so they can still be kind of compliant and fair.
Okay, cool. And then just to, I'm quite conscious of time, we've got a final view, which is the sort of the risk insight side of things. So this is ultimately what a lender will look at, which is, you've seen the affordability, you're looking at the very positive elements that are going on, but now we need to look at the other side of the equation, which is how likely is this person to be a bad asset.
Exactly.
And there we see capture, we've seen sort of phrases there like gambling, overdraft usage, and other such likes. And here we can see, I guess, overall behavior with regard to the overdraft in quite a high level sense, which is really quite neat. What are you looking for specifically from a risk perspective?
Yeah, so I guess the idea of this view, and you kind of touched on it, it's exactly right, is that to bring a snapshot, so to bring everything that you need to look at into, to make a risk decision into kind of one easy to use screen where you can see both these high level key risk indicators that are based on really up-to-date relevant financial behavior, so not just traditionally based on existing credit commitments and existing credit behavior, but based on financial behavior like, the time that you spend in your unarranged overdraft, your predicted gambling spend, your return direct debits, a whole bunch of different behaviors, and that you can see the kind of the high level indicators. So, how much of your income what percentage of your income are you gambling? And then also look at the kind of, those indicators alone are not enough. There's no single line of this is good gambling and this is bad gambling. You need to look at the context, and you can see here with loan repayments, you want to see, are the loan repayments steady or are they increasing all the time? Is this person getting loan repayments out to fund their previous loans? Are they in a debt spiral, or are they in, a fairly steady situation? And in the gambling example, are they, you can look at a specific spike or a turning point, and you can say, are they gambling when they're in their unarranged overdraft, or are they just gambling when they have disposable income? Is this kind of manageable?
Yes. And on the left there as well, I guess, quite neat little visual cues on the left, presumably for how a person's doing. The red sort of little spiky. I'm getting all kinds of different sort of Gantt chart fears coming over me when I see these circles and triangles and squares, but I presume that they're there for really quick snapshot overviews of how a person's doing, red, amber, green sort of thing.
We talked about this a huge amount, and we tested so many different combinations because we didn't want to send a signal that this was good or bad, but we wanted to give some kind of visual differentiator between this list of indicators, to say that this is fine, this is a 0, this might need attention, and this might need priority attention. And I think having those 3 different traffic lights gives you the maximum combination of different like a different feel for each person, and you can start to kind of learn that feel and compare it to people you've previously seen.
Okay. And is this, I guess, is there a real-time element to this, in the sense of a person there may be some changes in their risk behavior over a matter of maybe weeks or days? Would that be resonant, would you say?
Yeah, so it can be. So by default, reports aren't real time, they're a snapshot, but it's a very up-to-date snapshot. If you apply for a loan on Friday, you're going to have data up till that day. Reports by default are a snapshot because they need to be a piece of evidence. You need to be able to go back and say, this is why I made these decisions, and this was this person's situation at the time. We do have an add-on feature which makes use of the fact with open banking that you can get consent for 90 days rather than one-off. So we offer that as an option, and we handle all the kind of consent revocation and all of that stuff. And basically what we do then is periodically reconnect to the banks and get up-to-date data. And as a underwriter, as a lender, you can basically kind of hit this refresh button and you can get an up-to-date view of the report. So if you say, for example, you've been delayed and you pick up the application a week later, you can make sure you have the most up-to-date data.
That sounds really compelling as a feature, and probably one of the purer kind of use cases of like that open banking API calls sort of call and response sort of thing. The final question I'm just going to sort of ask about is this sort of better decision sort of side of things. So for you guys, you have a decision, you can make decisions. How would you go about constituting what is a better decision?
Yeah, this is really important for us because it's kind of at the center of what we're trying to achieve in the product. And we see this as kind of three levers, and the structure of the market is such that these levers help both consumers and lenders. So that it's basically accept more people who are good for the loan, so increase acceptances, and that increases access to credit and helps people access credit when they need it and when they can afford it. Reduce the rate of bad loans or defaults, so that's don't lend to people who are going to be have financial difficulty or who are going to not pay the loan and therefore kind of push the price of lending up, and lend more quickly and with less operational expense. And that basically helps consumers as well, because it helps lenders to provide more competitive products. It's a really competitive market, so helping lenders can help consumers.
Yeah, okay, that's and that final point there, I guess, does that reduce the operational cost, the overheads for these lenders as well, like being able
Exactly.
so you can, okay, that's where they make the margins up. That's cool. Final questions then. Obviously 2020 has been a bit of a weird one for most people, but how does this have any effect on your roadmap for the foreseeable? How does the rest of 2020 look from a product perspective?
Sure. So, I mean, as you mentioned, we kind of closed our Series A in April, and we've been very fortunate to kind of still be growing quickly, still be hiring, and as ever, we're never kind of resting with products. Every quarter, we're pushing kind of forward more with product, and I think what it has meant is we've had to kind of work even more closely with clients to kind of respond to and understand the challenges that they're facing. For some new clients, that's managing their re-entrance to lending, because lots of clients stop lending, or for our existing clients, helping them to kind of continue. It's meant that we've had to respond to slightly change our roadmap. We're still pushing forward as quickly, but we're just trying to make sure that we're responding to what's happening. So we're working on lots of different classification and prediction improvements at the moment, working on new scores and indicators. And we're also, a real focus on what's happening at the moment, trying to understand and predict financial distress, to help people to lend kind of fairly in the current situation. And we've also been working with some tier one banks, which has been really interesting. That's a slightly different use case because it's not open banking, it's kind of enriching their existing data, but hopefully also helping them to kind of serve their customers better at present.
That sounds like a whole other suite of products which might need to be looked at in some detail some of the time. But that's been a fantastic overview of how you guys are using open banking APIs to be able to assess a person's creditworthiness, I would imagine. So thank you so much for sharing that with us. Is there anything in particular you're really excited about for 2020 or the rest of?
I think, it's obviously a really difficult time, and I think, it's shown or it's going to show that open banking is kind of more important than ever. To actually really help people, we need new data, and people need kind of support so that they can get the right financial services. And there's kind of things on both sides of that. And, we've done some research recently that has underlined the connection between, credit and mental health. And I think that's really, we take this responsibility very seriously, that we're kind of key players in that. And I think it's going to be more important than ever. And I think we're just excited about doubling down on that and trying to make sure every part of the product is right for that.
Great. Well, thank you so much for your time.
Thanks so much for having me. Thank you.
So that's it for today. Thank you so much for stopping by. Come around next week when we've got more insights and journeys from another fintech. If you want to see a little bit more of the product that underlies the show, go to pulse.11fs.com or head over to our Twitter page at 11fspulse to find out a bit more about what we're publishing and how we can help you to build better products. If you've got any questions about how we operate the product, or even want to make a suggestion as to who we can speak to on this show, then hit us up, pulse@11fs.com on email. Again, go on that Twitter link, which is at 11fspulse. All right, we'll speak to you later.